Hello friends, good evening, and welcome back to the US Stock GPS channel. After Monday's strong rebound, US stocks opened lower on Tuesday due to renewed US-China trade concerns and profit-taking, but later recovered most of the early losses as dip buyers stepped in. The market then moved sideways through the afternoon and finished mixed. Investors are balancing a strong start to bank earnings season against rising geopolitical and trade tensions. Tonight, let's break down the drivers behind the intraday reversal, the sector rotation, key stocks, bank earnings, and Powell's latest speech. Morning sell-off, trade war worries, and profit-taking. The early weakness likely came from fears that US-China trade friction is heating up again. On Tuesday, both countries began imposing new port fees on ships, docking at each other's ports, directly raising shipping costs and sparking concerns about global inflation and trade disruption. At the same time, China's Ministry of Commerce sanctioned a Korean company linked to the US shipbuilding industry. These moves hit trade-sensitive sectors, especially large tech and chip makers like Nvidia and Broadcom, dragging down the Nasdaq and S&P 500 at the open. Coming off Monday's massive rebound, the best single day since May, many investors chose to lock in gains before new risks could erase them. The mix of profit-taking, renewed tariffs, and a higher VIX created a cautious mood at the open. Sector performance tech pullback leads the decline. The tech sector saw the sharpest drop. The Nasdaq fell more than 1.5% intraday, led by chip stocks. The reason? Multiple risk factors converging new tariffs, supply chain exposure to China, and sanctions involving the shipbuilding and logistics industries. These measures signaled that trade tensions are expanding beyond goods to maritime and logistics sectors, making investors worry about higher global costs and weaker Chinese demand. Nvidia fell 4.4%. Its 50-day MA flattening uptrend slowing. A 10%, 20% trim is reasonable. Broadcom Avgo dropped 3.5%, while Intel, INTC, and Micron also slid. Many chip makers depend heavily on China for revenue, especially in AI and data center chips. And the fear of tighter export rules added pressure. Defensive sectors take the lead. In contrast, consumer staples, industrials, financials, real estate, and utilities all rose, with consumer staples leading strongly. These defensive sectors tend to attract inflows when risk aversion rises, investors seek stable cash flows and dividends amid uncertainty. People will always need food, beverages, and household goods, no matter what happens in trade policy. As tech sold off, funds rotated into low volatility sectors that can outperform when the market turns cautious. Consumer staples focus. Albertsons, the grocery and pharmacy giant Safeway, Vons, beat both revenue and EPS estimates in Q2 and raised full-year guidance while approving a $750M buyback. Solid fundamentals and low volatility make it a steady midterm holding, ideal for gradual accumulation, not short-term trading. Walmart, Sanstein, announced a partnership with OpenAI to allow instant checkout via ChatGPT, sending shares to a fresh 52-week high and making it the top gainer in the Dow. Walmart is evolving from a traditional retailer into a tech-driven retail platform. The AI integration could become a major growth driver. The stock's breakout with heavy volume confirms its uptrend suitable for staged entries. Banks power higher strong, earnings season kickoff. Even as global headlines weighed on tech, the financial sector rose thanks to strong Q3 results from major banks. JP Morgan, Goldman Sachs, and Wells Fargo all beat Wall Street expectations, giving investors confidence amid macro uncertainty. JP Morgan, net income up 12% to $14. 4B, revenue up 9% to $47. 1B, record trading income plus 25%, and investment banking fees up 16%. Management added to credit loss provisions, signaling caution on consumer credit, but the stock remains solid. Gradual entry recommended. Wells Fargo, net income up 9% to $5. 6B, driven by net interest income, plus 2% YO from core lending strength. Shares rallied after earnings as investors applauded domestic resilience and ongoing regulatory cleanup. Good for staged buying. Goldman Sachs net profit jumped 37% to $4. 1B revenue up 20%, with investment banking fees up 42%, record high, and wealth management also strong. Despite cost concerns, GS remains fundamentally strong. Staggered entry suggested. Small caps shine. The Russell 2000 rose about 1.4%, signaling improving risk appetite and rotation into domestic cyclicals. While large cap tech dragged the Nasdaq and S&P 500 lower, small cap and value stocks outperformed as traders bet on rate cuts later this month, which would particularly benefit rate-sensitive small caps. Small cap highlights. Power integrations. After a 24% surge yesterday, it added another 9% today. Still viable for light, staged entry as a swing trade. Tetra Technologies, TTI, energy service firm expanding into water treatment, desalination, brine, and mineral extraction. Market cap tilde $750 M, TTM revenue tilde $607 M, EPS to 0.87. The stock spiked 13.5% on huge volume, suitable for small swing positions, not long holds. Spire Therapeutics, SIRE, clinical stage biotech, pre-revenue to $1, 1B cap. Shares soared after pricing a $275 M offering at $18.50, removing financing risk and signaling institutional confidence. High volatility biotech, best for light swing entries, not long-term holds. Indie Semiconductor, automotive and photonics chipmaker, focusing on ADAS and edge sensing. Revenue tilde $218, M 7%. YoY still loss-making, but improving. Today launched GaN visible DFB lasers for LiDAR and quantum sensing, fueling an 18.5% surge on massive volume. Small swing entry possible, not for long holds. Powell's speech. 67th Annual NABE Meeting. Fed Chair Jerome Powell spoke at the 67th Annual Meeting of the National Association for Business Economics. He acknowledged that economic activity remains stronger than expected, but job data show a low hire, low layoff environment. He emphasized that future rate moves are data-dependent, not pre-committed, and admitted the Fed is in a risk trade-off between stubborn inflation and labor market cooling. Markets interpreted his tone as slightly dovish, suggesting the Fed may cut rates 1 or 2 more times this year. Treasury yields, especially on the short end, fell in response. Gold as safe haven. Gold extended gains to above $4,100, divided by Oz, reflecting rising geopolitical tension and global uncertainty, as investors sought safety amid volatile markets. Closing thoughts. Today's session represented a healthy post-rally consolidation after Monday's surge. Overall, sentiment remains constructively cautious. Traders continue to buy dips and take profits on spikes, awaiting clearer signals from the Fed and upcoming macro data. Thanks for watching, friends. If you find this video helpful, don't forget to like, subscribe, and share. See you next time.